If you've been watching the markets and your accounts over the last couple of days, you're probably a little sick to your stomach right now and wondering what to do. Do you sell? Do you buy? Do you pour yourself a stiff drink? Well, don't buy or sell anything just yet. I'm going to give you my playbook for this tariff-driven market downturn, and the stiff drink is totally up to you. And I'm taking a different kind of approach here, so hang on until the end where I discuss what could be coming with these tariffs and a very concerning side effect that no one is talking about yet. So I'm recording this before the market opens on April 9th, and as of this morning, the market is down over 17% so far this year and almost 20% over the last 20 days. And futures were down when I checked earlier. First off, we need to take a step back and put all of this in perspective. While market pullbacks never feel good, they happen. And it turns out they happen a lot. There have been market pullbacks of 10% or greater in 23 out of the last 45 years. That's more than half. So talking percentages is one thing, but how does a 20% drop translate into dollars? If you have a $500,000 portfolio, a 20% drawdown puts you at $400,000. For a $1 million portfolio, a 20% drawdown means that you're $200,000 lighter. And for a $2 million portfolio, a 20% drawdown means you're now $400,000 poorer. That sounds pretty scary, right? But again, let's put this into perspective. Most of us don't have all of our investments in stocks. So if you have a $1 million portfolio that's 50% in stocks, a 20% drawdown in the stock market would drop your overall portfolio to $900,000 instead of $800,000, assuming all else stayed the same. So this is our step one here. When you watch the news and you hear that markets are down, remember that you aren't down that much typically. Jim Cramer's job is to capture eyeballs so CNBC can sell ads, not to give you actionable steps to improve your finances. Your next step is to calculate your war chest of bonds and cash. Once you've added all of them up, divide that number by your annual living expenses. Ideally, you'll have at least 3 to 5 years worth of living expenses in your war chest. Now ask yourself, how many years will it take to recover from this latest market pullback? Now, mind you, it took about 5 years for the S&P 500 to recover from the great financial crisis. So if you have more than 5 years worth of living expenses and cash and bonds, you probably don't need to sell anything. You have plenty of time to let the market recover. To take this a step further, we're already assuming that you've chosen your asset allocation, your split between stocks and bonds, for a reason. And if not, well, now's a great time for you to hire a fee-only financial planner to help you build your plan. So if we've calculated our war chest and we figured that we have enough in bonds, then you don't have to sell anything right now. So does that mean that you should start buying things right now instead? Well, not necessarily. Personally, I'm not a big fan of changing your investment strategy anytime that you feel like you're either getting crushed by the markets or getting left behind by the markets. Your current investment allocation fits into your financial plan for a reason, and 20% declines in the stock market aren't as uncommon as you would expect. Looking back over history, we find that there's typically 1 or 2 20% market drops every 5 years. So this is not an unusual situation. Instead of buying or selling and changing your long-term strategy, now is the perfect time to make a few rebalancing trades if necessary. Now, I made a video around rebalancing a few years ago, and I'll leave a link in the description. Rebalancing is a great way to methodically buy low and sell high, little by little over the years. So the market's down, but we have a plan and we're going to stick to it. And that brings us to the tariff situation. Will the goods that we import likely be more expensive now? Sure. Will the goods and services that are produced here likely be more expensive too? Probably. But we have to remind ourselves that we are not great predictors of the future. Is there a chance that these tariffs will be removed or negotiated away? Absolutely. So all of this may be temporary. And if the tariffs aren't temporary, then it's extremely hard to predict the second and third order effects of them. Markets and economies are unfathomably complicated. And my guess is that the future will not be exactly like what the proponents or detractors of these tariffs expect. So we do expect markets to go down with this kind of uncertainty, but the long-term effects are unknowable. And this brings us to the unexpected side effect that the tariffs are having right now. To retaliate against the tariffs, China has been selling US Treasuries in an effort to prop up interest rates. Now, Trump wants the interest rates to go down so that the US can refinance its debt at lower rates. China wants to get in the way. So the unexpected side effect of this is that increased interest rates in Treasuries have put something called the basis trade at risk. Now, to oversimplify this for time's sake, the basis trade is simply pocketing the spread between a Treasury bond's price and the price of the futures contract on that bond. The closer the futures contract is to expiration, the narrower that spread becomes. And since these spreads are usually pretty narrow to begin with, hedge funds will borrow a ton of money to do this at scale. Unless someone starts dumping all of their treasuries on the market, causing interest rates to rise and bond prices to fall. Now these hedge funds are starting to see margin calls because they're leveraged. So now they have to dump their treasury bonds along with other assets to cover. And now you have this snowball effect driving rates higher and bond prices lower. This is where the Federal Reserve could step in with an Operation Twist 2.0, like we saw in 2020, to re-inject liquidity into the system and stabilize the Treasury market. But maybe Jerome Powell doesn't want to look like he's bending the knee to Trump, so who knows? Hopefully egos don't get in the way here. So I would not be surprised if we saw more downward pricing pressure on the stock market over the coming weeks. Do I think that that's an issue long term? Probably not. But it might not be comfortable between now and its resolution. Okay, understanding all of this is going on in the background, we have to ask ourselves, will this be the first time in history that the stock market went down and never came back up? I think you know the answer to that. I say all the time that investing is an inherently optimistic endeavor. And that doesn't mean that our returns are always positive. And it certainly doesn't mean that it's a comfortable ride. Remember that we expect one 20% drop every 4 or 5 years. As Warren Buffett said, the stock market is a device for transferring money from the impatient to the patient. And so with that in mind, we know what our job is here. It's to avoid the human tendency to do something at precisely the wrong time. Look, all this tariff stuff and market drop are scary. It is completely normal for you to feel sick to your stomach if you're checking your accounts every day. But what's the point of having a strategy if you don't stick to it in the good times and the bad? I'm completely confident that the world's best companies, those that we invest in, will eventually figure out how to thrive in the changing economic environment. In the meantime, our cash and bonds are there to help us stay the course. Personally, I have not made any changes to my portfolio other than doing some rebalancing trades. So what's your playbook here? Number one, take a deep breath and just realize that a 10% drop happens roughly every other year, and a 20% drop happens once every 5 years or so. Number two, calculate your war chest by adding up the total values of all your bonds and cash. Number three, divide your war chest number by your annual living expenses. Ideally, you have between 3 and 5 years worth of living expenses there in your cash and bonds. Number four, I personally would not change my overall allocation in the middle of a market pullback. I would wait until the market has recovered before I consider doing anything remotely like this. Number five, rebalance your accounts if they've moved too far away from their original target. This is our methodical way to buy low and sell high over time and take emotion out of it. Number six, if you're still panicking at this point, go ahead and review your budget to cull any unnecessary items. Now, within reason, too. There's no need to go on the austerity program because the market's down a little bit right now. And finally, number seven, if you don't have a financial plan, now is the time to get one. Click on this video if you want to pull one together in under 5 minutes. I'll see you there.